Hello everyone and welcome back to the channel. Today we're going to see what Tax Shield is and how it can help your project to boost its profitability or a company to improve its value. But before we get started, make sure to subscribe to the channel and give a thumbs up if you enjoy what you're seeing here. Let's go. What is Tax Shield? Tax Shield is any sort of business expenses that helps a company to reduce the taxable income or the amount of income on which taxes are calculated. There are basically three main components of the tax shield. The first one is operating expenses, which is any sort of expenses necessary to run a business, such as cost for labor, cost for maintaining a machine, equipment, or to rent a piece of land. The second one is interest payments, which is the cost of borrowing money. Tax authorities recognize this as an ongoing cost for the company to run its activities. Therefore, it is considered a tax shield that we can use to reduce the amount of taxable income. The third one is depreciation and amortization, which is different things, but are combined here together because for the purpose of this channel, we don't really have amortization. So what is depreciation and amortization? These are accounting methods used to allocate the cost of assets over their useful life. Depreciation pertains to tangible assets like buildings and equipment, while amortization applies to intangible assets like patents. By spreading the initial acquisition cost over the asset's lifespan, these methods create deductible expenses. As an example, if a company buys a machine for $1 million that produces 1 million bricks, tax authorities recognize an extra $1 operating expense per brick, which derived from the initial investment cost of 1 million divided by 1 million bricks that will be produced. How do we calculate the tax shields and the impact on the tax payable? Let's take a look here. What we have here is a profit and loss or income statement for 2 years, 2023 and 2024. And the goal here is to calculate how much tax we're going to pay. For the first line of P&L, what we have is the revenue. We're going to assume the same revenue for both years of $1 million. Then we're going to have the three components of our tax shield: the operating expenses, the interest payments, and depreciation and amortization. And I'm going to reduce these out of the revenue. So what we're going to have here, first I'm going to just calculate the operating profits or the EBITDA, which is the earning before interest, tax, depreciation, amortization. And from here, we're going to reduce the interest payments and depreciation amortization. So as you can see here, the only difference between the 2 years is that on the second year, I do not have any sort of interest payments. And as you can see here, when you calculate the tax payable based on a 20% rate, we're going to pay more tax on year 2024 than in year 2023. And the only difference is because in 2024, we do not have any sort of interest payment to reduce the amount of taxable income. Now that we have our tax payable, or how much tax we're going to pay, we have to plug this number here into our cash flow calculation, which comes below here. Remember, the profit and loss is not the cash flow statement. There is a difference between there. And the main reason is because depreciation and amortization is not a cash amount. Okay, it's not some money that is going off out of the company. So we need to calculate the cash flows of the company. So for the cash flows, what we're going to have here, we are going to assume that both revenue and operating expense are only cash. Okay, there's no credit in here. So we're going to have these two numbers plugged in here. Then we're going to plug in the interest payment. We're not going to use the next line of our P&L, it's depreciation and amortization, because as I just said, these are not cash outflows from the company. It is just an accounting method. But we have to add here the principal repayment, okay? Because whenever we have interest payments, we also have principal repayment. So this is the principal repayment that we're going to have. Then below that here, we're going to have the taxable payable. So that's what we have. And at the end of the day, when we add those two things together, we're going to be able to calculate the cash flow to the company. So this is what we have in here. But to really grasp and understand how this can really impact the project profitability or the value of the company, we have to take a look at a more complete example. So let's gonna do this just now. Here we have a more complete cash flow analysis for a given project. So what do we have in here? So first we have here the timeline, which is made of yearly periods of a total length of 15 years. So that's what we have in here. Then we have here the capex, so how much money is needed to build this power plant. We're going to assume $20 million. Next, we have how we're going to fund this project. Okay, so we're assuming here 50% equity, money coming from investors, and 50% debt, money coming from banks. For the revenue, we're going to assume a revenue of $3 million for each one of the periods. And then we're going to have here our operating expense, which we're going to assume as being $500,000 per year. We're going to calculate our EBITDA, which is the difference between revenue and operating expenses, as we just had in our previous example. Then we're going to have here the interest payment, which I am calculating below here, okay? And we're assuming that we're going to have a 15 years tenor for the debt with a 4% interest rate per year. We have our interest expense in here, and then we have the depreciation of the assets. So what we're doing here, we're going to assume that we're going to be able to depreciate 100% of the value of the asset in 15 years. And as you can see here, we depreciate the same amount. It's a straight line depreciation, which gives us $20 million. After, we're going to calculate the taxable income, which is the EBITDA minus interest expense minus depreciation, as you can see here. And from here, we're going to apply the tax rate to the taxable income, which is these numbers in here. And it changes over time because we're going to pay different interest expense for each one of the periods. That's what we have. And as we just did in the other analysis or in the other example, we're going to calculate the cash flows. In this particular case here, I'm going to calculate the free cash flow to the equity investor. So from the equity perspective, what would be the cash flow? So how much money, how much cash the equity investor would be pocketing? Okay, so that's where we calculate here. And after, we're going to calculate the IRR. So what do we have here? So first, the investor is putting $10 million. Okay, the investor in this example here is not putting $20 million. The investor is only coming up with $10 million because the other $10 million is being financed by the banks. Then what we have the revenue. So we're going to sell 3 million, and we have to reduce now all the cash outflows from the project. So we have the operating expense, the interest expense, and we have to add here the principal repayment. So there's no depreciation here because depreciation is not cash, but we need to add the principal repayment because we did get 10 million from the bank and we need to pay it. And that's exactly what we have in here. We are paying back the 10 million bucks we just got from the bank. And the last one is the tax payable, which we have here. And when we add all these things together, essentially what we have the free cash flow to the equity investor. And once we calculate the IRR, we get to the result that this particular project results on an 11% IRR to the equity investors. Let's see how depreciation and interest rates change the project's return. Let's see. Let's go and start first with the depreciation. So what I want you to see is I'm going to change here the total depreciation years for this particular project. So we're going to do it in a much faster way. And what I want you to see is how does tax payable change and the IRR change. So let's see. I'm going to, instead of having 15 years here, what I'm going to have 5 years here. So two things happen. So first, there is a change here. So depreciation, instead of depreciate 1.3 million per year, we're going to depreciate 4 million per year. But the interesting thing is that there is no change in the total tax payable. It is the same number. Let me press Ctrl Z here. And we're going back here to 15 years, but the number here has not changed. Let me go now for 5 years. So what happens here from the government's perspective is that we're only deferring the tax payable to the government, but we're still paying the same amount of tax. But when you look now to our IRR, what happened here is that we were able to increase by 2% points the IRR from 11 to 13. actually we increased by 20% our IRR approximately. So that's a huge increase for a project just because we are depreciating the assets faster. But the question is it legal? Can we do it according to tax authorities? And the answer is yes. And in fact, in the US, it is possible to depreciate assets in 5 years' time. So this is the effect of depreciation into the project's IRR. Let's gonna see now how the interest payments or actually leveraging the project, taking that into the project helps the overall profitability of the project. I'm gonna go back here to 15 years and I'm gonna come back to the 11% we have. Now instead of changing the total depreciation years for the project, what we're gonna do, we're gonna change the debt, the amount of money we're gonna take from banks. And what I want you to look at is how much interest payment we're gonna pay and what happens with the IRR. So let's gonna change here. So the first thing I'm gonna do, I'm gonna assume that I'm gonna have no debt from banks. I'm gonna put number 0 here. So everything is gonna be financed by equity investors. So what happens in here? So essentially there is no longer interest payments and there is no principal repayment in here, right? Because there is no debt. But look what happens with the IRR. Now the IRR is only 7.5%. The question is, how is this possible? Because we no longer have any interest payment or principal to repay. And the answer is because now instead of having $10 million in the first year as a project cost, we're going to have 20 million from the investor's perspective. And this makes the whole difference because the less you disburse in the first years of the project, the higher is going to be our IRR. So the effect of leveraging in your projects is huge in the project returns. Let's going to go back here to 50%. And before press enter here, see how this number here is going to change. The 20 million, this number here with the interest payment, and the IRR. So let's going to press enter. And as you can see here, now we have 10 million here, and our IRR goes to 11%. And look what happens now when we go from 50% to 75%. Essentially, we're jumping from 11 to 16% project IRR. Let's gonna combine both now. Let's gonna see what happens when you go for 75% debt and a 5 years depreciation schedule. So we jump from 11% to 22%. So we doubled our IRR. For finalize, let's gonna recap what we just learned today. Tax shields help us to reduce the total amount of tax we're gonna pay for a given project or a given company. There are basically 3 components of tax shields: operating expenses, interest payments, and depreciation and amortizations. And we also learned that the change in the number of years you depreciate an asset only defers the tax we're going to pay to the government because the total tax payable still is the same. And for the interest payment, it's much more about leverage. The more we leverage our projects, the better the project returns will be. So, this is it for today. I hope you have enjoyed. Please subscribe to the channel, give a thumbs up if you learned anything from today, and I'll see you in the next video. See you.